Welcome, it's Kevin Prince from BMO Exchange Traded Funds, and welcome back to our weekly session Market Insights webinar. We're going to take the next 30 minutes and provide you some insights to the overall market, as well as answer some questions and answers to the end of this. Today, we're going to have a theme around tax loss selling and give you some insights around that as a strategy in the current marketplace. And of course, I'll highlight anybody out there, you can get a replay of this webinar. It will be sent out as part of the survey at the end next day. And I'll also highlight that you will have a chance to provide some further question and answers for next week's session. And those are absolutely key for us because that helps us build the content that's aligned to what you're thinking and your needs in the marketplace for these markets. I get the pleasure of introducing our two guests today. And let me advance that screen forward, bear with me. I'm a little challenged in advancing, bear with me. Well, first I'll introduce Mark Rays from BMO Exchange Traded Funds. He's our head of product, and he's going to talk to us about different ETF strategies today, as well as Patrick Sineza. He's going to talk to us from the TMX. He's going to give us insights around derivatives and derivative strategies in the marketplace. Steve, if you're there, if you can help me advance slides, that would be great. But while we're doing that, I'll quickly highlight there's a couple of disclaimers for everybody. In those disclaimers, the key thing to know about there is this is not meant to be advice. It's really meant to be insights to the overall marketplace itself. Oh, and the other thing I'll quickly start off there too is we had a lot of questions this week in regards towards oil and gas and specifically, what's going on in the oil and gas market. And so I thought we'd address that before we go into, the whole conversation around tax loss selling. And the key thing here is I think you need to look beyond the news and to really look at some key information in the marketplace to understand what's going on. Because also to think about here, what is really going on is in regards towards pricing of futures contracts. So when you're hearing oil is going to zero, understand that's related towards futures contracts. And the good news about this webinar series is we have an expert to share with you, Patrick from TMX, to share with you some insights, what's going on in oil and gas, and specifically oil and gas futures. So you can take it beyond the news and think about the information and what it really means. Maybe I can hand it to you, Patrick, get this session started and start talking and give some insights around the oil and gas.
For sure. And so thank you for having me again. And so we want to advance to the chart where I'm showing the May crude oil futures contract that has now expired. And so what everyone saw in the headlines was the fact that crude oil traded to minus $40. And it's very hard. I mean, if even going back a few years, it's hard for people to conceptualize negative interest rates, but now negative crude oil rates makes absolutely no sense. But it's important to reflect that it wasn't actually physical crude oil that was trading negative. It was a futures contract for future delivery that traded negative. And it was sort of a perfect storm phenomenon of a number of things that happened all at once that actually caused this probably once in a lifetime event to actually happen. Obviously, issues such as storage in Cushing, Oklahoma, and other variables were sort of part of the headline, but it was an imbalance on a futures contract that was expiring on April 21st, and the whole event occurred on April 20th. And normally in the futures market, you have only into the final 3 days of a futures contract, only those that are willing to take physical delivery of the commodity are allowed to be holders. And so any speculators or anyone else that are in the markets participating would have to have already closed that contract in advance. And what ended up happening, at least the rumor was that a very large fund from Asia that held those futures contracts not from a commercial hedging perspective, but from a speculative perspective, holding it on behalf of investors, actually held into that day and were actually forced to close. And they simply, knowing that this fund had to get out, came in the trading phenomenon of basically clipping them and essentially they didn't make a market for them to get out and force them out at a very heavy price. So no physical oil actually traded negative, but rather the future obligation of that. Now, so we do see though very low oil prices. So if we could advance to the next slide. What I do want to point out, though, is it doesn't have the same impact on energy companies that a lot of people interpret, because this showing the term structure. I'm not going to get into all the contango and backwardation terms and all the other stuff that happens in the futures markets, but we do want to point out that if you even go out 6 months to a year, many of these oil companies are able to forward sell their oil in the 30, 40, $50 price ranges. And so really the supply and demand imbalance that was driven by this COVID-19 economic shutdown is all about oil that is being delivered today. And so it doesn't have the same impact. A lot of people were shocked that a lot of the energy companies weren't crashing when oil was going supposedly negative. And in fact, many of these energy companies were flat. And that's largely because it's only modestly influencing their fundamentals. The bigger term structure of oil is still not that much down. But I wanted to, if you advance the next slide, what I wanted to just discuss was some of the understanding of how oil ETFs work. And so there's a number of popular ETFs, including leveraged ones, that are basically giving investors exposure to oil futures contracts without the investors having to actually do the futures trading. They allow the fund managers to do it for you. And normally, because of the nature of oil in backwardation, I'm using terms that are a little more sophisticated, but normally they were able to roll these futures for investors at even a positive carry in many cases, and which meant that the ETF functioned normally. But this collapse has created this problem where this contango means that when this ETF is actually closing, let's say today, the June contract, and in the ETF rolling it over to the July, you can see here right now they would have to close, and this was yesterday's prices, the June contract at $16.80, and immediately buy oil out into July at $22, basically paying a $5 penalty. And this is in this roll forward is actually bleeding the ETF and investor money. In fact, if you look at some of those ETFs and you look at the price of oil and say, why doesn't it look anything like it? Why does it look like the ETF is doing far worse? It's actually the nature of it. And so the takeaway I'd leave it there with, Kevin, is that for most retail investors, if you don't understand that fact that there's more speculation to these ETFs than simply your bet that oil is going higher or lower, then it's better that you turn to a lot of energy company ETFs rather than the energy crude oil ETFs, because there's a lot of additional risks associated with them that a lot of investors don't understand. And at least when you're playing the energy companies, it's just about company fundamentals and about the balance sheets of the energy companies themselves, rather than all of these sophisticated derivatives that a lot of these other ETFs own. I think that's I'm done there, Kev.
Well, Patrick, I think that's great. I mean, what you're really highlighting there, and I think it's quite insightful, is that yes, the futures contracts for a certain delivery date went to zero, but what really not oil itself, because you're seeing the term structure over the period of time still be add value, and they're still delivering oil and value in the marketplace. Now, of course, we do know the market's still challenged. We're not going to say it's not challenged. Certainly is, but there's a little bit difference between the news and the information, and I appreciate you really diving a little bit deeper into that for everybody to get that insight. And for those out there who heard some interesting terminology from Patrick, there is a conference he's going to talk about at the very end. That's where you're going to get some very much detailed insight on those terminology, and you're going to spend a day talking about derivatives, and we'll talk about that at the end of the session here. Hey, Mark, just before we jump to the next part here, just go back one slide. Mark, one of the key things, that first question, I didn't really speak about it, is, and I think Patrick did try to address it there, and I'll turn to Mark. If this oil and gas, it's a big noise out there, people are thinking of ways to play this. Patrick said, well, talked a little bit about some of the challenge in ETFs out there. Mark, is there some way in the ETF space you can play this, and maybe give us your insights around that?
Okay, sure. Thanks, Kevin. As Patrick mentioned, there's really two types of energy ETFs, those that are investing in the commodity via futures contracts, and those that invest in energy companies like Suncor here in Canada. So those that use the commodities realize that they are exposed to the near contracts, which are going to be undergoing, at least for the foreseeable future, a declining price until there gets to be demand in the marketplace. Now, we've already seen the June contract start to come down. Hopefully, hopefully investors will be a little smarter about exiting their positions closer to expiry. But you are going to see that for the next few foreseeable months, that until demand and the economy starts going again, there's going to be a decay of those front month futures. Even though the longer term expectation, let's say around year end, is that oil will jump back up towards 25, 30, and maybe beyond. Now, the difference to the equity-based ETFs then is they're far more exposed to the long-term outlook on oil. As Patrick mentioned, they hedge their production. So because they've already set the price for their production, let's say for the next year or so, they don't really care what's happening in the short end of the market. What they care about is, what does oil look like a year from now, 2 years from now, when they have to reset and keep their pricing policy in place going forward. So those types of companies are going to be impacted by the long-term impact to demand, and therefore the price of oil. So that's the big difference between the two. As well, I'd say when you're looking at equities right now, it's probably wise to be focused on large caps. Those are the companies with stronger balance sheets, with diversified operations, that'll be better able to withstand a prolonged downturn, as opposed to smaller companies, exploring companies that really, survive on a much shorter time frame. So overall, I'd be looking at equity base. I'd be looking at large cap base, something like our ZEO, which is an equal weight large cap energy company ETF. Thanks, Kevin.
Thanks, Mark. And it's good to highlight the two different types of ETFs out there, definitively. Let's transition now and talk about tax loss selling, the key of our conversation today. Now, what I'd like to do here is first provide everybody kind of a background. And then what we're going to do is give you some examples of the implementation of this in both an ETF perspective and a derivative perspective. I'm going to ask Mark if you can give us the background first, or an overview of tax loss selling, and then lean into an example. And I think we can do the first example of still staying in the oil and gas area.
Sure. Thanks again, Kevin. So tax loss selling or tax loss harvesting is simply looking at your portfolio and where the current price might be lower than your average book value. You can look to take advantage of that in terms of managing your taxation, sell it to capture or realize that loss. And if you still want to maintain that exposure, buy something that's in the similar industry, or an ETF that gives you an exposure to an industry if you happen to have individual company exposure. So that way you get the best of both worlds. You still own something that's very similar to what you had before, but you've captured some losses. And the nice thing about capturing losses is you can carry it back 3 years versus gains that you may have had to report. Now, tax loss selling is something that most people tend to look at closer to year end when you're thinking about your taxes. But we're in a very unique situation right now where we've had such a sharp market correction, and with a lot of volatility and unseen forward path of markets, it might be a good time now to really have a look at your portfolio and see if there's any losses that you want to capture that way. The key is make sure that you're buying something similar and not something that is considered the same. So you can't just go and sell your Suncor shares and then buy Suncor shares a week later. There is a minimum 30-day period where you can't have that same exposure. And that's why with tax loss selling, you look for something similar. So again, an energy ETF like ZEO is a reasonable tool to use if you're using tax loss selling on a company like Suncor. Thanks, Kevin. Kevin, you there?
Sorry.
We may have
Sorry. This is a good slide too to highlight. Maybe we should talk about this a little bit too, Mark, too, about why the ETF makes sense for tax loss selling.
Well, I think what an ETF provides you more than anything is a diversified exposure to the same industry or sector that you might be looking at. So again, an energy ETF is a great replacement for an energy company, assuming you want to remain invested in that space. ETFs are low cost, they're well diversified. They're very transparent, so you see the holdings on a daily basis, exactly what's in that ETF. So it's effective, efficient way to make the trade, and there's no surprises in doing so because you know exactly what's in that ETF.
And I think that transparency is the key part there, because you can look underneath the hood and see, is the exposure trying to be similar to, back to your point, in there, so you can keep the market exposure while you're implementing the tax loss strategy itself. Let's skip ahead in the slide here if we can. Now, this is the example that Mark brought up around ZEO. I think we covered this already. You can certainly see there's been some losses in their space. I want to hand it off to Patrick to say, let's take a look at it now from an option perspective, implementing a similar tax loss strategy.
Right. Thanks, Kevin. So the what Mark was talking about was great, because if you, let's say, sell Suncor and then you buy an ETF that has all the energy companies in it, you're getting a very similar correlation. In fact, the performance is often very similar, and so it isn't one effective way of doing it. But sometimes investors have a very specific reason for wanting to own a very specific company, and so one of the interesting ways that you can use options to do this is the fact that there's this 30-day window where you actually have to be out of the stock in order to realize the loss. And so one of the biggest fears an investor has when doing this is that if I turn around and sell, let's say, my Suncor shares at a loss and wait 30 days, what if the stock market rebounded? Because usually during a market crash, there's a reflexive rally on the other side that often bounces the other way. And so if you sell into this loss to realize it and then miss this big rally on the other side, then often it leads to remorse and it could hurt your longer term performance. And so what's interesting is you could always consider an option as a way of being tactical about this. And so just to review, an option, a call option, is a contract that gives you the right to buy a stock in the future as opposed to buying it today. And so if I actually go back one slide there, so we're just going to build a scenario where investor, let's say, had 100 shares of Suncor originally at $45, and today Suncor is trading at $21.59. At least it was on April 22nd. And so for whatever reason, after looking at their circumstances, this investor comes to the conclusion that realizing the loss on Suncor is beneficial to their tax circumstances. So what they do is they go ahead and sell it at $21.59. So now if we move forward to the next slide, we can turn around and secure, in this case, let's say a June $21 call option, which is trading at $2.51. So this call option gives the investor the right to call in or buy the Suncor shares back at $21 a share out in June, which is going to be more than 30 days later. That's almost a month and a half away from now. And so buying one call option on Suncor today for $251 or $2.51 per option, they now have the right to purchase the shares at $21 at any point between now and June. So of course, once the 30-day window passes, you have a choice. You can either A, exercise the option and call in the stock at $21, or if the stock kept crashing, and let's say Suncor is at $18, well, guess what? You're not forced to buy it at 21. At that moment, the option expires and you can buy back the shares at $18, long as the 30-day window has passed. And so the point is that while you can make the lateral move to an ETF, you could also choose to use an option to do this. Another example of this, if we move to the next one, is doing it on a bank stock. Like for instance, let's say it was TD Bank and you originally bought the shares at $75. Now here it is trading at $55. So the investor wants to realize that tax loss. So if we move to the next slide, you can see if they sold at $55, a slightly in the money call option at the $54 strike on TD was trading at $4.30. So again, you would buy this $430 call option, which basically now gives you the right to actually exercise and buy in your TD Bank shares at $54, and you would do so obviously after the 30-day window has passed, and then you could call it in. And so it's and you can see that your average cost base is higher because you actually have to pay for an option. For the optionality, it comes at a premium. That to do this strategy is not for free, but if the tax loss benefit, the benefit of you realizing the loss against your taxes is totally worth it. It's going to save you a lot of money against other gains you've made. Well, you can turn around and consider the price that you paid for the call option a small consequence of doing that. And so that it really comes down to that you have two choices. You can move laterally into an ETF that has the similar exposure, or you can use an option like this as a way of actually securing the price. And this is really good because in the end, the worst feeling is if you sell your TD Bank at 55 and suddenly a month later it's trading at 65. It's always a really emotionally hard thing to turn around and actually buy your TD back at 65 after watching it rally $10. By you having secured a contract that guarantees you to buy it at 54, it allows you to know that over the 1 month holding period, you've actually secured a guaranteed purchase price and it can't run away from you while you're waiting. What do you think, Kev?
Well said, actually. And as we moved into financials, let me turn it to Mark, because let's talk about the same concept, but utilizing an ETF to implement that strategy.
Sure, thanks, Kevin. Well, I think it's a similar story in that a lot of Canadian investors, of course, hold our banks. They're well-known names that form core positions in our portfolios. However, year to date, they have suffered some significant losses, particularly with exposure to the energy market. So you can make a similar transaction, a tax loss sell, versus a bank-based ETF like our ZEB or the covered call version, ZWB. We have talked about covered calls in a couple of these calls. What the covered call essentially allows you to do is harvest additional income at the cost or trade-off against excess upside. So there's two different ways that you could go after tax loss selling on banks. So very, very similar story to energy. However, this tends to be an area where Canadians really have a core position in their portfolio. So if you are looking at the strategy, banks is certainly one that should be high on your list right now.
Thanks, Mark. And let's talk about some key considerations here too. Now, first, I want to highlight that you should always consult a tax advisor before implementing your tax loss investing strategy. Right? This is just information, not advice. Keep in mind the 30 days that we spoke about a few times, because you need that as a period of time before you re-enter the exact same security. Also, while we gave you some examples towards oil and gas, as well as we gave some examples in financials, this can be done on other investments, such as bonds, preferred shares, different ETFs, mutual funds for that matter. So there is more choices out there. And as Mark said, you can actually carry it back 3 years too, in addition to having it used against the current year or future years for that matter. So it is a strategy to factor in to your overall strategy across the board. So now let's flip gears here and talk about some of the questions that came in from the audiences out there from last week, and appreciate one more time for all the questions that come in. The first one I want to talk to you, Mark, is in regards towards return of capital. I think it's kind of a little misunderstood out there. And so maybe we can have a little insight around that, about what return of capital is in respect towards ETFs, where you can find out the information on return of capital, And then more specifically, maybe some inferences between good and bad return of capital out there. Mark, maybe let me hand it to you.
Sure, thanks, Kevin. Return of capital is something that relates back to tax, where essentially it's part of your own invested capital coming back to you as a distribution. And from a taxation perspective, since you're getting your own money returned to you, it's not taxable. However, investors do look at return of capital sometimes with a bit of a jaded eye, thinking that, well, really, you're just paying me my own money back, so what's the point? I would say there's a significant difference between what we call good ROC or ROC and bad ROC. The bad, of course, is when you're depleting your invested capital, and that's when you're paying out an aggressive distribution rate. The good ROC could be based on how the portfolio is constructed. It might be tax efficient, but it might also be that the invested portfolio is growing. So if you're paying a somewhat fixed rate or a targeted rate, you might have less taxable amounts per investor just because the number of investors are growing. So there's a big difference there between good ROC and bad ROC. And what you can really watch for is an ETF where the distribution rate just doesn't compute, doesn't make sense. If it looks aggressively too high, there's probably going to be some bad ROC in it. Something like a covered call, which I mentioned earlier, actually has good ROC because part of that monthly distribution, in fact, can be capital gains and may end up being return of capital just because of the return on the marketplace. So there's different ways that you can find what we call good ROC. How can you find it? You can simply go look on the provider's website. There will be a distribution tab. Typically, you can just flip back to the last taxation year, and you can see the tax factors down below. That can be used as an indication for the upcoming year. Of course, it's not necessarily going to be the same, but it'll give you a strong sense of how much return of capital that particular ETF has had over the last year. Thanks, Kevin.
Thanks for that, Mark. And what you're seeing on the screen here, if it helps you, is there's some insights if you're looking for what to expect during tax season. It's a nice document, kind of covers over generically what ETFs in the marketplace and what you should expect during the season itself. If you're looking for it, just go to bmoetfs.com, look at any one of the ETFs, and look at the tax distribution tab, and this will be an FAQ right there for you. So nice little support for you. Just to advance to the next slide, let's talk a bit about a few more questions before we run out of time here. Mark, to you, ZWU, ZLD, these are different types of factor-based ETFs, cover calls and that stuff. Ultimately, what people really want to know is, give us some insight, which ones tend to do well in different markets, and again, tends to do well, and maybe talk about mature companies in that aspect too. If we can advance to the next slide, I think this is kind of a good graphic kind of to lay the background of your conversation.
Sure, thanks, Kevin. One of the things you always want to think about is where we are in the market cycle, where the economic cycle is. We're certainly at a point right now where markets are correcting that we're end of cycle. You want to be more defensive in nature. So in terms of sectors, I saw utilities was on the previous screen. That's a very defensive sector, where essentially you're going to avoid the more cyclical things like energy that we talked about off the top of the call. In terms of factor exposures, when markets are declining, low volatility is certainly something to consider, as well as quality. Low volatility because it's generally picking or overweighting to sectors that are more defensive in nature, but just as importantly within sectors, picking the more defensive companies. In quality, just because those companies tend to be market leaders and they're better able to withstand the friction and the stress in the market and really distance themselves from some of the competitors. If you take it the other way and start looking at a market recovery, that's when you'll get into other more pro-growth factors like value and small cap, things of that nature, or more cyclical sectors, such as energy. So it is very important to realize where we are in the cycle, and that applies to both sectors and factors. Thanks, Kevin.
Thanks, Mark, for that. And I think we're almost out of time here. One thing I want to quickly highlight, I know, Patrick, we mentioned at the beginning there, you've got a session coming up in the next few days. I mean, let's just quickly highlight that and talk about where we can get more education around options.
Oh, for sure. And this is what a great opportunity this is for everyone online, because normally we do these options education days in person. And so you have to actually buy a seat and dedicate a day for it. But because of this COVID-19 circumstance, we've gone virtual with it. And so the virtual options education day is actually happening on Monday, on April the 27th here. And it's basically a 4-hour session, live webinars where speakers such as myself are educating investors all about options, everything you want to know. And more importantly, it's a free event. So make sure that any of you that want to take yourselves to the next level and learn how options work and how you could take advantage of them, make sure you visit that Montreal Exchange website. Actually, go back to the previous slide there. And it's /VOED for the sign up for that website there. And so hopefully we'll see everyone online there. I'll be speaking at 2 o'clock on that day. I think it is 2 o'clock anyway. But thank you very much.
Thank you very much, both Patrick and Mark, for your support today. Very good insights in marketplace. We'll be back next week at the exact same time, 1 o'clock, to dive in for another half an hour of market insights. One request for everybody here on the call or on the webinar today: if you have any questions, please send them in as a response towards this survey. That really helps us build the content for next week. Thank you. Have yourself a good week ahead. Cheers.